Hello everyone. Today we're going to talk or finish up our discussion on Chapter 11. What I have showing here is the due dates for the chapter exercises and problems. Let me know if you have any questions on them. We're scheduled to take the test on Thursday, and again, you can take it at home. That will be fine, and it opens up on that day. If that day doesn't work for you or you're in your schedule, we certainly can also make arrangements to open it up early if you'd like to work on it earlier. Just let me know and I can do that for you. Obviously next week then we start chapter 12, which is our next chapter in the book. So today it is mostly a review day. So most of the things we'll be talking about are problem related, and I want to start off where we left off last week, and that was this negotiated transfer price. So the problem I picked to do that discussion or kind of review it is problem 44 on page 639. It talks about Western Division, which has a Southern Division and a Canadian Division. Southern Division requires a plastic pot. These pots can be stored externally. Company policy permits them to decide whether to buy internally or sell it internally. Each division manager is evaluated on the basis of ROI. So we have Western. Just so we can kind of make some notes here. Western is the buyer. I think Southern is the seller. Yep, Southern is the buyer or seller. I'm just working on problem 44, guys. Do you have your packets by chance? Do you, Carl? Okay. We have some cost information on making the box. $35 of materials, $8 of labor, variable and fixed overhead, $10 a piece. For a total cost, full cost, right, of $63. Current selling price is $75. And their production capacity is 20,000 units. Seller, Southern, is looking to, the buyer, which is Western, is looking to buy 3,500 boxes at $75. So we're looking for 3,500 units at 70. So I'm just trying to get some basic information down here, guys. 3,500 units, and the price is $70 per unit, which is about $5 cheaper than the actual selling price to the person outside of the company. So again, buyers trying to make make about $5 on their purchases. So the first question says, suppose that the plastic factory is producing at capacity and can sell all that it produces to outside customers. How should Lauren respond to Rosario's request for a lower transfer price? So again, this is a negotiated pricing problem. We have a ceiling and a floor. And one of the questions on the test will be, who sets the ceiling? And then who sets the floor? So who would set the ceiling price? Remember from last week? Anybody? The buyer, yes. Very good, Carla. So the buyer sets the ceiling, then obviously the seller sets the floor. So please know that. So the ceiling price is $70, because that's what they're looking to buy it for. The seller, though, is also going to be, well, actually, I'm sorry, it's not 70, it's 75. But they're currently paying for it. They're currently paying it. They'd like it for 70. However, the seller's also at the same price, 75. And the reason this is at 75 is, remember, we are at capacity. And they can sell all units produced. And that's what capacity means. They're at capacity. They can sell all the units that they make. The question changes then in number 2, where now they're not at capacity. They're currently only making 16,000 units. Right here. We've got room to make 4,000 more units, of which we only really need 3,500. From the buyer only needs 3,500. So now the scenario changes. We're still going to have a ceiling and floor scenario. And they both change. So the buyer and the seller set the ceiling and the floor. Now we can say the ceiling is 70 in this case, because we're not at capacity. The company that is selling them is not at capacity. So they're looking to buy it for $70 a box. The question then comes in, what is the minimum the seller is willing to sell it to the internal division, which is Western. So here we got to decide what variable costs in dollars make up that floor, right? So going back to the previous page on 639, what variable costs do I include in this number, this computation here? What's one variable cost?
The direct materials?
Yeah, the direct materials. So I have $35 of direct materials, plus what?
8 for labor.
8 for direct labor. There's one more.
And then the 10 for variable.
Yeah, which was 10.
Mm-hmm.
So the sum of 35, 8, and 10 is 53. And that's my floor, right? So on the exam, you'll have to look on these negotiated problems. as to a discussion on capacity. If they're at full capacity, there really is no ceiling and floor. They're the same number. And at this point, when we change the scenario where there is capacity, then we have to cover our variable costs. Now, fixed cost, whether I make these units for Western or not, they don't change under either scenario. So that's why they're not included in this analysis. So from our last, or 2 chapters ago, this was called relevant costs. What costs change when I do make it or I don't make it, right? And those 3 are the relevant ones. So the question then says, for problem 2, should Lauren consider the transfer price at $70 a box? So we have our ceiling and floor. Actually, I think now that I think of this 70 should be what? 75. So I'm going to change that. Because that's what they're currently buying it for. So they certainly wouldn't want to pay any more than 75. Because the negotiated price is 70, does 70 fall between the ceiling and floor? Yes, it does. So the answer to question 2 is yes, the $70 fits between the ceiling and floor. And that's what we're trying to determine here. That $70 fits between the 75 and the 53, right? So here's my floor, here is my ceiling. So that would negotiate, that would work. All right, so any questions on the ceiling and floor discussion at home? Are we good out there, guys? Okay, thank you. Awesome, thanks guys. All right, there's one final question, question 3. Again, seller's not at capacity. Should seller sell to Western at full cost plus 20%? So I'm going to extend this page here. What was our full cost?
The 63.
Yeah, the 63 was the full cost. And the term full means it has 4 parts. Direct material plus direct labor plus the variable and the fixed. All 4 components make up the full cost. That was $63. I'm going to add a markup. That's the plus 20% is $12.60, I think. Anybody at home? $12.60? Okay, awesome. Thanks, Sandy. So the selling price desired by the seller is $75.60. Well, the buyer already can get it for $75. So why would I pay more for that same part? So would this transfer take place? And the answer is no transfer. because we're certainly not within that negotiated range. I'm only going to pay $75. Why would I pay $75.60? So that's kind of the analysis here. We try to make, remember, each manager is judged on their performance, right? And performance is a measurement based on profit or ROI in this particular chapter, return on investment. Okay. Going forward here, quite a bit of what's left in Chapter 11 is definition stuff. I'm just going to go past the kicker. Here's how it's used. Appendix A in Chapter 11 has this concept called balanced scorecard. The appendix starts on page 611. So if you have your book handy, jump to page 611. Now, the term balanced means multiple scorecard. It's like golf, it's like bowling. This is a scorecard to measure, again, the performance of a division or a company. And if you look on page 611, there's 4 parts to it. There is a financial perspective, which is where accountants, we are in most cases, cost per unit, profit per unit, that kind of thing. But in addition, we shouldn't always concentrate on the economic numbers, right? There should be, in addition, a customer perspective, an internal business operation perspective, and there are a couple of small measurements here that we can do today, specifically cycle time, velocity is in this section, and MCE, manufacturer cycle efficiency. Cycle meaning process, right? How we make something is contained in that internal business perspective. And then finally, we have to have employees that are happy. We have to have employees that can strive for a progression within the company, that growth perspective. Not everything motivates employees by the dollar amount that they're paid. There are very many intrinsic concepts or ideals that can motivate employees to work for a company and progress within that company. So what I would like you to do is just basically read the scorecard types, what's found in each scorecard. On the test, these are multiple choice questions, guaranteed. So here we're looking at the financial measurements, right? Or for, I believe, yeah, the financial perspective. So what are the objectives on the left? How do we measure? Is on the right. So on the test, you might be asked, well, we have a cost per occupant or a revenue per room. This is a hotel that they're analyzing here. Well, what perspective of the 4, which one does that fall into? Well, this would be a financial perspective. If you look at, maybe a better one would be, there's learning and growth in here. They're kind of all in this little section here. Let's just go back. Operating cost, oh, here's the customer one. So here's some customer perspective examples. internal examples coming next. And then there should be the learning and growth section right here. And surveys or scores from employees, post-training for employees, maybe rewarding employees with memberships to organizations or it's that sort of thing. So that's kind of the learning and growth section of it. So those have all the 4 components to that process. So read those on your own, kind of know what's in each section or what part does that process go to. We'll have an example coming up shortly here in a problem. Our next discussion on page 612 revolves around strategy. Every company has a strategy. Basically, how do we compete in the marketplace? What makes us better than somebody else? Is it our delivery? Is it our service? Is it our quality? Is it our price? Right? Those are all different strategies. So once a company picks a strategy, then we got to figure out how to do it, right? How to make those strategies basically come alive. So there's some good examples on Walmart here, Hilton here, Analog Devices. Take a few moments and read those different types of strategies. Because we want to set measurements based on the strategy. So here again is where that balanced scorecard comes in. Once we have a strategy, again, we got to set a way to do that and then come up with measurements and targets that we can hit those strategies. So there are a couple other definitions in here, and they talk about measurements, targets, right? Those are pretty self-explanatory. And I'm just going to go through, there's Coors, Miller Coors. Oh, they also talk here about sustainability. What does sustainability mean in most cases for a company? It's mostly revolves around environment, right? Uh-oh. Spelled it wrong already. The environment, right? Carbon footprint is a big, how much are we adding to the emissions in our air, that sort of thing, or how much waste are we adding to our landfills. So that is a very important component, and people are buying from companies based on this actual measurement. So now we're measuring this kind of non-financial information, and it's actually reported in a lot of SEC reports for particular companies. And Walmart's one of them here. But another term I want you, and remember each strategy has to be testable. So this picture is on page, if I jump ahead a little bit, 614. And all we're doing here is, here we have an objective, do some training, right? Quality training to redesign our products. What is that supposed to do, right? Reduce our defects, which should increase what? Our customer survey, and it just kind of satisfaction, and it kind of goes through that whole process. So what's our strategy? Better quality products, right? So how do we attain that strategy through these steps here? So sometimes our strategy and our way to perform that strategy isn't correct. The assumptions here are incorrect. So know what a double loop feedback is? This is on page 615. Not only of the effectiveness of implementing the strategy, how did we do that, but also what's it testing? The validity of the assumption. So if I'm improving my quality, right, I should have a better customer appreciation for our product and more sales. Is quality really what our customers are willing to pay for? Is that how we're competing? So that's the assumption. If I do that, then what? I should have increased sales. So that's assessed in this double loop and the actual implementation. Did we have the correct quality checks in place to make that strategy work? The opposite of double loop is single loop. Here we're only looking at the effectiveness of the implementation. So that's the difference between those two terms. We're under a single loop. We're not concerned about the assumptions. So in other words, again, if we're going back to our quality issue, we know if we have better quality products, we're going to have more sales, guarantee. So we don't care about the assumptions. We just want to make sure that we are getting a quality product here. The effectiveness of the implementation, right? Okay, here's a little more detailed on my slides as to what's under financial. So now I'm at page 615, all the way through 616, 617, and 18. All the examples for each perspective. Financial, customer, internal process, and then finally, after internal process is learning and growth. So what I'd like to do before we look at the velocity and so forth, if I could, now I don't have this in your packet. I don't, or do I? Do I? Okay, awesome. I didn't think I put it in there. So if you could, find this in your packet. Problem 48 is this discussion on the 4 balanced scorecard perspectives. Now some of these, again, could be fit in more than one of the 4. So I'm just taking the author's assumptions here that this is the category they wanted in. So I'm going to start, well, let's start with letter A. Number of new customers. Of the 4, which measurement would that fit in on my balanced scorecard?
Customer?
Yeah, customer. That one's pretty straightforward. So just put a letter A under the customer category. Again, in the test, you'll be given the same kind of things. You got to tell me which one of the 4 that it should sit under. Percentage of customer complaints resolved within 1 contact. Which one do you think that falls into? And
Learning and growth, or is it customer?
yeah, well, actually, it's the 3rd one, internal business process. Right here. Could I argue with customer? No. So some of these are, like I said, could fit into multiple categories. How about unit product cost? Somebody from home? Unit product cost? Sydney's taking it. Yeah, you're right, Sydney. Very good. Financial. So C belongs up here. Unit product cost. Cost per distribution channel. Anybody want to try it at home? Letter D. Sandy wants to try it. Financial. Very good. Yes. Letter D is financial. Again, the book will help you find these categories also for the test, if that helps. Suggestions per employee, Carla, is, yeah, that's where the learning and growth one goes. That's an example of learning and growth. Warranty repair cost. Here again, it could fit under 2, but the author thinks it's here. It could be customer too, I would think. But I guess letter G is what? Olivia, letter G.
Writing and growth? No, customer.
Customer is the better choice. Yeah. Letter G is here. H, cycle time, which we're going to compute shortly, is under the internal business process. Oh, I is a big one. Learning and growth. I is strategic job coverage. And basically what that means, if I have a production facility, I'm working on the press brake, I'm sick, we've trained Olivia or somebody else to take my position, right? Take my spot so we can keep working. So strategic job coverage means if I am sick or an employee is sick, who else can do that same job and do it well? So if that is our goal, obviously we would need training to make that happen. On-time delivery. Anybody at home? On-time delivery. Which section would that be important for? Yeah, very good. Excellent. Customer. So some of these are kind of pretty self-explanatory. So I, J, and the last one, anybody want to stab at it? It's one with 2.
Maybe financial.
Financial, yeah. It's actually financial. So K is over here under financial. The revenue from new product streams. All right. Let's then jump to our discussion on internal growth, cycle time, velocity, and MCE. So this discussion begins on page 619. You need to know the difference between cycle time and velocity. Okay. Cycle time is the time it takes to make a product, one product, right? And it's time, it says it right on the slide here. Cycle time is the time required to make one. So time is on the numerator, usually hours. In the denominator is units. And again, this can be in minutes also. Minutes can be the time factor. But most often it's in hours. Velocity is units over time. So be careful on the test. Do not get the two mixed up. It's very easy, right? They almost look similar. Don't make that mistake. Units over time. How many units can I make in an hour basically is velocity. Remember, these are these two, cycle time and velocity, are a operational measurement. And it can be a great measurement technique to see how we can maybe improve our operations, make them better, be able to produce more in a given period of time. And that's the goal here. Because if we can do that, we should be able to lower our cost per unit. So example 5 is our example for both measurements. On page 618, goes into 619. Here we too have another terminology. So the maximum units that gate can make in a quarter is determined to be 200,000 units. Their actual production capacity at the present time is 160,000 units. So quite a bit different than the goal. Productive hours in 1 quarter, 40,000. So what we have here are two terms, theoretical and actual. Theoretical is perfect. No wasted time. No equipment failures. Nobody's ever sick. Nobody ever takes a vacation. It's the perfect scenario. Actual time, obviously, we do have those imperfections in our operation. And we're going to compare that difference between theoretical and actual. So the computations, they're converting the measurement into minutes instead of hours. So all you have to do is take the minutes, 60 minutes in an hour, times the production hours available, which is 40. So that is 2,400,000 in minutes. I'm going to divide by 200,000 units, and I get 12 minutes per unit. So my perfect time it should take to make 1 unit is 12. But as you can see, using the actual units produced, in reality, I'm only doing 15. So we have 3 minutes of supposed wasted time that we maybe somehow could reduce. Velocity is the reciprocal of cycle time. So the only difference now is I have units on the top number. The minutes are on the bottom. Well, they got it now per hour. What is this? This is 200 divided by 2,000,004. Which is 0.333 times 60 minutes to convert it to an hour equals 5 units. So basically, for every minute, I can get about 8% of a unit done. So I need basically, 12 minutes to get a full unit done? So I'm just converting that to units per hour. Velocity, again, is mostly determined in per hour numbers. All right, let's try one and see how we do. Cycle time, actual and theoretical. Velocity, actual and theoretical. This is on page 636. So theoretical is perfect. Theoretical is perfect. If it was perfect, how many units should I be able to make?
The 50,000.
Yeah, the 50,000. So cycle time is what? Units over time or time over units?
Time over unit.
Time over units. So get in the habit of actually writing the formula. The units Carla said was 50,000 in the perfect scenario. In how many hours do we have available? 10,000. So I'm going to put hours on top. This is 0.2 hours per unit. And how do I convert this to minutes? This is how long it takes to make one. Well, normally I don't say 0.2 hours. What do? We do minutes, right? So what do I do now to convert this to minutes? Yes, times it by 60 minutes, which is 12 minutes. So in a perfect world, it should take us 12 minutes to make one unit. So question 2, same computation, but what's our bottom number now? How much, Carla?
42?
No.
Or you mean like an actual?
How many units? That's the difference. This is actual. How many?
Oh, that's 40.
40. So that's a quarter of an hour per unit. I'm going to convert it to minutes. Just like before, we multiply by 60. This is exactly the same answers as our example in exercise 5. So I'm actually at the present time making that unit in 15 minutes. So here's the goal then for our production manager is to move in the direction from 15 to 12. And you could actually give them performance measurements to attain that goal. Now the velocity is just the reciprocal. I'm going to switch the denominator and numerator around. So now it's units over time for velocity. How many units can I make in 1 hour? So theoretically, I should be able to make 50,000 in 10,000 hours, which is 5 units per hour. That's theoretical. And then actual, again, same. We had actual units of 40 as before, 10,000 hours to produce them, 4 units per hour. Again, we might be at 4. The goal is to get closer to 5 as we hopefully perform better in our operation. So this is an internal perspective, an internal measurement to help us meet that particular goal. Any thoughts, guys, at home on the difference between velocity and cycle time? Or or anybody here? It's a pretty simple computation, but just got to make sure we're in the right direction. Silence means good. All right, thank you, Sandy. All right, our next measurement, internal operational measurement, is called MCE, Manufacturing Cycle Efficiency. This is on page 619. And the discussion revolves around value added time. Again, perfect time, no waste, no wasted time, no looking at YouTube videos at work, or the news at work, or picking brackets in the basketball pool at work. No wasted time over total time. So this is actual time. What's our operational MCE? So the author talks about value added time, and then they talk about what is considered non-value added time, that inefficiency. There are some listed right here. Move time, inspection time, waiting time. Please know those for the exam. This is another great multiple choice question. What are the non-value added items? So the book goes into much more detail. If I can find it. Oh, where are they? Maybe I took them out. Oh, here they are. Please know these non-value. We talked a little bit about this in chapter 8, I believe, already. Processing time, again, is the perfect time to make something. The sum of these two, right, is the actual time. So that's our bottom number. Let's try it. I only have one problem for this. Let's see how it goes. The exercise example is 6, and their MCE turned out to be 80%. 12 was the perfect, 15 is the actual, 12 plus 3, that's 80%. So we're going to try 39 as our example for this MCE computation. So here we have maximum units that should be produced as 180. I'm actually only going to I'm making 112 based on 30,000 hours. The theoretical time is 10, and the actual cycle time is 16 minutes per. So the amount of processing time that it should take is 10 minutes. That's it. There's no computation here. That's what it should take to make 1 unit, 10 minutes. The non-processing time is, well, my actual minutes were 16. I'm going to subtract the 10 minutes. That's the perfect. Leave me with 6 of waste, also known as non-value. So here is that wait time, inspection time, those non-value added items. That's 6 minutes. per part. So the MCE is going to be what? The perfect time on top. What's my bottom number?
Six.
16, right? The actual. So what percentage is that?
Yeah, 62.5.
62.5? The goal is to be at 100%. Will we ever get to 100%? I don't think there's a possibility. It would be almost impossible. But can we get to 70? Maybe. Or 80? Maybe. So that's again why this figure or this computation is good to review to see how we're doing. Now, on the test, I get wrong answers. I've seen this done on the test. Or neither of which are right. What I'm computing now is, this is the bad stuff, right? The 6/16. This is 60, which again, this means nothing because both the top number and the bottom number are wrong. So, but again, your answer keys, A, B, C, D, will have those other percentages where students will pick the wrong numbers and enter that as their answer. So even though it's a simple computation, be very careful with this entry or this computation. Make sure you have the total time on the bottom. Both, right? Both value added and non-value added time. So on the test you might be given wait time was 3 minutes, inspection time was 3 minutes. The actual time was, to make a perfect one, is 10 minutes. Right? So I'm not going to give you 16 and so forth. So you got to be sure that you're going to take the 10 and divide it by the total time, which is 16. So try to be careful with this question. All right, let's take our first break here, and we'll come back and do our review test after that. All right. The last section, I'd like to do some pre-test questions. They're called blueprint problems, so this is a problem that I got from the last edition. And first question is, select one correct item from the following list, assuming all the other components of ROI, return on investment, remain unchanged. Check all that apply. Okay. If operating income increases, will that reduce our ROI? If operating income increases, what effect does that have on ROI? Does it decrease or increase? It should increase, right? So let's not check that one. If the average operating assets increase, then ROI will decrease. Maybe we should do this. How do I compute ROI? What two numbers do I divide? Let's start there maybe.
The operating income divided by the average operating assets.
Perfect. So income in dollars over assets. Now I know these are average operating assets. So if my bottom number goes up, what will that do to my return on investment? So I'm at this one now. If this number is going up, what does that do to my ROI? If the bottom number is bigger.
It will decrease.
It will
Decrease.
decrease it. Very good. So this is true. So this is true. So here again on the test, it's a very tricky question, but you need to know how the income and the assets affect return on investment. So let's do the third one. If the operating income and sales increase, then ROI will decrease. Well, sales is a component of income. If this number goes up, what does ROI do on the top? If ROI, or if income goes up on the top, what should that do up to our ROI? Increase it, right? So we can't check the third one. The fourth one, if average operating assets decrease, then ROI will not change. So again, we're looking at the bottom number. If we go down on my assets, what will that do to my ROI? The bottom number goes down.
Would that increase it as well?
That will increase it. Very good. So remember, if a company is in trouble, right, what's one of the first things they do? They get rid of all their assets that are not used or unused assets. So they start selling off that. By reducing the bottom number, the denominator, that will increase ROI. If the assets are going up, right, that will decrease ROI. There's at least one question, if not two, on this relationship. You need to know the effect of these two, income and assets, on our ROI. 3 points apiece. So if you miss both, you're almost down to a B already. Okay? You got her? Any questions? Clear as mud? Okay. All right, let's go to the next part 2 here. We're making picture frames here. Total revenues of $2 million last year with a cost of goods sold of 1.2, selling and admin of 300. At the beginning of the year, their operating assets were 2.3 million. At the end, 2.7 million. First question, compute the operating income. Well, I'm going to need my sales. What's my first subtotal on an income statement? What's that called?
Is it
Gross margin? Right? But is that the answer we're looking for? No. We need operating income. So I got to subtract one more thing. Selling and admin, which was 300,000. So what's my operating income? $500. So 500,000 is my answer for letter A. Average operating assets, how do we get that?
You have the beginning and the ending divided by 2.
Yep. So we're going to add these two numbers together. 2.3 plus 2.7 is 6 million. Divided by 2 equals 3 million, right? Oh,
I think it was
no.
5 million.
Oh my gosh, you're right, Carla. I was going to say, how can my average be higher than my two numbers? Oh my goodness. 5 million, that look better? How about 2.5 million as my average? Good thing we got so many auditors here. Margin, as a percent. How do I get C's answer? Margin as a percent. We can use our little income statement to help us here. I'm looking for my percent. Right? How do I get that percent count, that vertical analysis done?
It's the operating income divided by sales.
So you're down here. Yeah, that's income percent. Where's my margin though?
Oh, that 800.
Up here, the 800. So 800,000 divided by 2 million is what percent? 40, right? So what must be my cost ratio? Has to be what? 60. My cost ratio is 60 because my top number is the 100. Right? So the answer for C is 40%. So for every, I always like to do this, every dollar of sales we make 40 cents. Right? That's what that 40% means. For every dollar of sales, we make 40 cents. And again, we've covered that in a previous chapter. All right, our final answer, or letter D, is turnover. Sometimes the industry calls this sales turnover, right? Sales turnover ratio. How do I get that particular number? Guys at home, how do I get the turnover ratio? Anybody remember? Can you Google it? Anybody at home can do it? Okay. We've done this before. It's sales over assets, right? 2 million over my average operating assets were 250, or 2,500,000. So 0.8. That look right?
So for like a different problem, if you don't have the little income statement, do we use the?
We have to create one.
You do?
Mm-hmm.
So you don't use the margin formula thing that's on here?
Oh, yes, you can. We just haven't gotten there yet.
Oh, okay.
Yeah. So under a two-component approach, they're basically doing what? They're multiplying the 0.8 times 40%. So the ROI is what we're computing now, is what? It should be 32%, right? So let's do it with one operation. Carla, I think this is what you were saying. I'm going to take the 800,000 divided by the 2.5 million. Does that come up to 32%? I hope it does.
Yeah.
Does it? And that should, right? The book goes through that process of doing it either way. So on some multiple choice, I might just give you the turnover ratio and the margin, right? And you got to know how to use those two to get the ROI. If sales go up, what will ROI do? I'm quizzing you on that multiple choice question. If sales go up, what does that do to ROI? It goes up, right? If costs go up, what does that do to ROI? Decrease. If assets go up, what does that do to ROI? Decrease, right? If assets increase, ROI is going to go down. Look at if the bottom number gets bigger, right? That's going to make the ROI go down. If assets decrease, what does that ROI do? That would go up then. You've got to know those scenarios. What effect does that do on the, because you as a manager, you got to decide if my bonus is based on ROI, I better know how I can make it bigger, right? How do I make it bigger? If my margin per unit goes down, what does that do to ROI?
It goes down.
Down. Margin is like profit, guys. So if my profit goes down, right, my ROI is going to go down. Margin per unit is just on a per unit basis rather than just saying margin. That's the only difference. All right. Guys, did that help at home? Guys, did you fall asleep? Great, Sydney, thank you. I can't tell if you're outside having a drink, so that's why I gotta ask. I'm glad you're still with us. Okay, yeah, it does sound good, doesn't it? All right, let's go on to our next page here. Very similar. Couple other new things that we learned in chapter 11 was residual income. So we're given the same information. Operating income is the same, 500,000, right? So I can just plop that number in because we've already computed it. The average, it was 500, right? 2.5 was the average operating assets. That didn't change. But this is new. Residual income. Now to get residual income, we need to know the company's minimum rate of return. So we have to give this to you. And you notice the answer for residual income is going to be in dollars. Return on investment is usually a percentage or a decimal equivalent. Okay, so the formula is we take our operating income and we subtract the ROI percentage, the company's ROI, times average assets. Oops. That gives us our residual income. So putting numbers in, we start with 500,000, we subtract, what was the company's percentage? 8.08 as a decimal times 2.5 million. And then we are done. So that's it. So keep handy those formulas. If you want, you actually could do this in Excel and create an Excel formula that would compute residual income. So 8% of that, is residual income 100,000? No. 10% would be 250.
It's 200,000.
Is it 200? So you're telling me, Carla, this is 300,000?
Yeah. Wait. Oh, I thought you were talking about the 8% times.
Oh.
It's the other way around.
Okay. I'm glad I second guessed. I got her. Let's start over. So 8% of 2,500,000 is 200,000. That gives us 300,000 for residual income. So 300,000 good for a residual income. The answer is yes, it's really good. So here's some more things I want you to know about residual income. If RI is positive, that means the division ROI is greater than the company desired ROI. If residual income is positive, the division ROI is greater than the company's ROI. So, in other words, the company's desired ROI was 8%. This division is greater than that. What was our percentage from the previous page? $32, right? So is 32 greater than 8? Yes, it is. So that's why I got such a huge positive residual income. So please know that for the test. If this number is positive, then we know the division is higher than the company's desired. If it's negative, then we know the division return on investment is lower than the expected company return on investment. And economic value is very similar to residual income. It too is $1. And if it's positive, we are creating wealth, is the concept here. If it's positive, it's destroying wealth. If it's negative, so we have after tax now. Remember, it's after tax for EVA minus the cost of capital, which is basically the bank's borrowing rate is 12% times the assets employed, the average assets employed. 12% of 600,000. $72. And we subtract that from 120. 48 positive. So again, we're creating wealth. I'm making more money to pay for the finance charges, basically the bank interest that is found under buying this amount of assets, the 600,000. I'm above that borrowing 12% amount. All right, last item for today is transfer pricing. I'm going to make an assumption here. Here it is. Guys, do you have this on your notes? I don't know if you guys have that. So please add that to your information here. Selling and buying division are owned by Overall Corporation. Selling has 115,000 units that cost $11.55. So of this cost of $11.55, $3 of that cost per unit is fixed. And they sell it for $27.75. So here's the selling price. Buying division needs 12,100 units from an outside supplier for the same selling price. If selling division has excess capacity, they have room to make the 12.1. What is the upper and lower limits? And then what are the sale effects? So again, buyer sets ceiling, seller sets floor, I'm really going to be hurt if someone misses this question on the test. I think we've gone over it quite often, so please don't miss this question. Who sets the ceiling? Who sets the floor? The ceiling is the buyer, and the ceiling is $27.75, basically what they're paying now. But under an excess capacity, which is what we have here, what is the floor? What cost do I need? Just the variable ones, right? Just those. How much did that total?
1155 minus the 3.
Yeah, very good, Carla. 1155 minus the 3. So the floor is 855, actually. What a range. So I could sell it for 10 between companies. I could sell it for 15, 20, 25, whatever it is. So let's be nice. Let's negotiate the price and make it $20. Obviously, I'm between the ceiling and the floor. This transfer is acceptable. The transfer is acceptable at the $20 mark. So how much does the buyer save by doing it at 20 versus 27.75? So I'm doing the buyer here. I was at 27. I can now get the parts at 20. I save, right, 775 per times 12,100 units. This is a whole lot of ching. I didn't quite make 100,000. $93,775 is saved for the buyer. They're happy, right? Let's do seller. We're selling something that we didn't sell before at 20. The cost was only $855 for materials, labor, and overhead, variable overhead. So now I'm making, because my fixed costs are sunk, I'm making $1145 times 12,100 units. It's a cost, or a profit, profit of $138,545. The company as a whole then, company earns or saves the total of these two. $232,200. Oh, I didn't write that down right. 232,320 it is. $232,320. So the seller is happy, the company is happy, everybody's happy, right? Somehow I think I can do emojis in here. What would those emojis be? Oh, I guess I got a star. And the company is happy. All right? Have you guys had enough review? All right. That's all I have. Do you have, anybody have any questions at home? Sandy? Eric? All right. Well, thanks for joining us on such a lovely day. I will be here on Thursday. I'll be in the classroom for anybody that wishes to come in and take their exam here. So if I don't see you, good luck on your test and have a great weekend.